I'm Edward Lawrence at the Jackson Hole Symposium, the 42nd Jackson Hole Symposium put on by the Federal Reserve, the Kansas City Federal Reserve. And joining me here, Esther George, the president of the Kansas City Federal Reserve. Thank you for joining me.
Good to be here.
First question about the symposium. You're putting together, central bankers, you have economists and philosophers. What does that do for you in terms of going forward with monetary policy, in terms of shaping your opinion?
Mm-hmm. So every year that we come up with a theme, a topic for this conference, it is designed to directly inform policymakers at central banks on how to think about issues of our time. As we thought about this topic on changing market structure, we began to look at issues like the productivity numbers in this country, wages, labor, to say some things have been characterized as puzzles, and maybe we should look to something more structural in the economy to try to explain it. So we chose this topic as a way to bring insights to policymakers to say it affects how policy is transmitted. It may affect how we think about the tools that we apply to that. So that was the motivation for this year's conference.
And you mentioned the economy. What's your assessment right now of how the economy is doing?
I think the economy in the aggregate is doing well. I describe it as firing on all cylinders, and we're at a good point right now in the economy, which has allowed the Federal Reserve to begin to remove some of the stimulus that we put in place years ago.
So then what do you see the risk factors in this economy?
Always risk, and I think for me, I'd characterize them as both upside risk, so things like a pro-cyclical fiscal policy, which is boosting growth, at a time when we have accommodative policies. On the downside, I look at things like the uncertainty that's coming from the trade discussions, and where will those come out? We look at what's going on in emerging markets to see some of the challenges they face. So you look at both sides of that risk equation. I think right now they look balanced, but by the time we get to our September meeting, you have to reassess.
Well, see, you mentioned pro-cyclical U.S. in your last speech. You were a little bit worried about that. You said that that with the accommodative monetary policies could overheat or get the economy running pretty hot. You still have those concerns now?
So I think I still watch that because that's in play. You saw the second quarter GDP numbers came out fairly high, and we're going to see, I suspect, for the year as a whole, GDP will be running well above the potential for the economy. So it's something to keep an eye on. It's not necessarily a bad thing, but it's something you have to calibrate in terms of what would appropriate policy look like if that continues.
Well, we'll get into tariffs in a bit, but do you think some of that GDP growth in the first and second quarter was to get ahead of the tariffs that were coming in, companies sort of looking forward?
Yeah, so yes, it was, and particularly when you look at net exports, you saw that soybeans shipped out at a higher rate, and that boosted that GDP. That's not likely to continue, but then again, you don't know what else will come into play in the current quarter that may sustain some of that growth. So I don't expect that will continue at the clip that it did in the second quarter, but it probably will be higher than we've seen last year.
Well, and we'll get back to that in a little bit, but the Federal Reserve believes, many of the members of the Federal Reserve believes in the gradual unwinding and gradual normalization of the accommodative measures that have been put into place. Do you think that's the way to go? Do you think they're doing it appropriately?
So I support the gradual approach to normalizing policy, and you have to remember how dramatic and in some respects unorthodox the kind of policy stimulus that the Fed undertook. So as we begin to pull away from that, I think we want to do it in a manner and have communicated, and I support that, moving in a gradual fashion so that we can monitor how the economy is doing and yet keep moving forward.
Yeah, and in that normalization, in that monitoring going forward, there are some concerns and risks of the economy coming into this, right? I mean, are we, we're looking at a proposed possible 2 more rate hikes this year, maybe some next year. Is that moving gradual enough for the economy, or are there bumps that are coming?
Well, I haven't forecast any bumps. I hope we don't run into them. But obviously, shocks can come to our economy at any time. So you remember that these forecasts are not commitments. They're individual policymakers' best view of how I think the economy will unfold and what I think appropriate policy goes along with that.
So then how close do you think we are to neutral? I mean, you talked about in your last speech, how some language saying that the stance of monetary policy remains accommodative, but that stance may need to, or that language may need to be removed from the statement. How close do you think we are to normal?
That's a good question, and it's one I think my colleagues and I continue to explore because our objective is to maintain the long-run growth of the economy as best we can, and trying to understand when we get to normal is a function of knowing, remember, this policy acts with lags. So each time that we have made an interest rate increase, that will flow through the economy after the fact somehow. And so that's why you focus carefully on what do we see in the data, what do we see in the trends, and what are we talking to people in our regions about, in my case, to understand how that policy is affecting people in the economy.
It's interesting. So you're comfortable with, well, first, there's a lot of other tools also that the Fed used, and they're sort of unwinding the balance sheet now. One of them was to expand the balance sheet. Are you comfortable with unwinding and how that is unfolding?
So that has gone well so far, and I have supported the approach of a gradual reduction in that balance sheet as well. And so far, so good. It's still a big balance sheet, and I think we still have a ways to go before we can conclude how this came out.
But there's an accompanying concern with the yield curve. The yield curve is narrowing, and many folks, in fact, in the last FOMC meeting, the language in there said a number of the participants there were looking at the yield curve as, assessing policy and economic outlook for the future as sort of an indicator for a recession. Some other folks say, well, we shouldn't look at the yield curve today like we looked at it in the past. How do you feel about the yield curve as an indicator?
So I understand why people look at this, and we should look at the yield curve, because history tells us that when the yield curve flattens and then inverts, we've experienced recessions, and obviously no one wants to do that. So the question is, what circumstances lead to that inversion, and why are we seeing a flattening yield curve? And that's where I think the debate is right now, of trying to understand what the dynamics are in the economy. Because remember, we are still at negative real rates, so even though that short rate's been coming up, trying to figure out what's suppressing the long end of the curve. Is it because investors believe that the Fed's gradual approach, managing inflation low, means longer term rates won't be as high? Does it mean that because we still have a very large balance sheet and other major central banks are continuing to add to their balance sheets, that could be suppressing that? I don't know the answer to that, and we won't know it. But that's why I think we pay careful attention to the yield curve, but it's not our sole objective, obviously, as we go forward.
And that's not something you look at solely.
You can't look at it solely, because remember, what I have to look at is the mandate Congress gave us. But you look at lots of signals, and the yield curve is an important one, and I think my colleagues and I are going to keep our eye on that.
And the inversion, you mentioned the inversion, that is an indicator for you, one of the indicators that possible recession. Okay.
It could be. But again, predicting a recession isn't a very good business to be in, is it?
Yeah, and well, another downside risk to the economy is tariffs. We talked about it a little bit.
Right.
The U.S. is imposing $16 billion worth of tariffs this week. That would make $50 billion worth of tariffs on Chinese products alone. We've also threatened or have tariffs on other countries like the European Union, Canada, and Mexico. How big of a concern are these tariffs for you as the economy grows?
Right. So this is an area I watch very carefully, and as I told you earlier, I consider it to be a downside risk from the standpoint that it's hard to gauge. If this is all we see, then maybe we would conclude that will work through the system and it won't affect economy the size of ours. On the other hand, if it looks like this will continue, if there's some persistence to these discussions, if it leaves businesses feeling uncertain, that could flow through to holding back on investment or less investment. And that's something that I'll want to watch carefully to see if that will show up in the data at some point.
And in your last speech, you mentioned that a lot of companies are asking that wait and see, taking that wait and see attitude. Are you still seeing that today? And is that growing?
In some businesses. So I do hear from some of our businesses in the region that say, I'm going to pause on some projects until I see. Others will tell you this hasn't affected me, or I'm passing through higher cost now as a result of that. So you get varying reactions, and that's what makes it difficult to say precisely, this is what it means to the economy going forward.
The retaliation tariffs have been targeting agriculture. I know that's a big deal for your district, specifically China targeting agriculture. Are they feeling the effects of that? Are you sensitive to the effects of that at the Federal Reserve when you're doing your
Oh,
meeting your business?
absolutely. So in a region like mine where agriculture is significant, obviously the tariffs associated with soybeans are a significant aspect, and it's something that we hear from farmers about. And we take that into our analysis about how the economy may unfold. So very important that we stay in touch with people in our region when some of these things affect, so that we can make our best judgments about how that will affect the broader economy.
And have those issues that you've been hearing, have they been picking up as the year goes along, as these tariffs are unfolding?
So I think there is broadly concern about trade. Now remember, farmers really look to external markets to put their product out there. But they too want to understand, will this lead to more opportunity for me or less? And I don't think they have the answer to that yet.
And in the minutes of the meeting, this last meeting that was released, it says that there's some discussion about how tariffs could possibly put upward pressure on prices, inflation. Mm-hmm. How big of a problem is that as we go forward with these tariffs?
So I think the issue there will be whether that will be a temporary boost to inflation and one that the central bank should look through, or whether there's something more persistent behind that, whether you see a more general increase in prices that would lead you to think that that is affecting inflation more generally. I think it's too soon to know that right now.
And so how do you gauge that then? You just keep looking at the data? Is there a time period?
Obviously, you look at the data carefully and you try to judge the nature of those increases. So for example, if that's coming through right now on steel prices, and there may be something else that offsets it, that may be a one-time boost and then it levels out. So those are the kinds of things you look at before you react, and sometimes it takes several quarters to understand it.
Is there a trigger for you specifically when looking at this to alter maybe monetary policy?
So I look carefully at inflation expectations and watching not only the quarter-to-quarter movements in the price level when we make our forecasts, but looking at how inflation expectations are responding to that. And so far, those are remaining pretty well anchored, so I don't see a reason right now to react.
And you do believe that the companies, they were buying forward, but you believe the third and fourth quarters would still be as significantly strong going forward?
Yeah, my forecast for the year, and again, I don't know where the third quarter will come out, right, but we may see the year as a whole more in the range of 3% as opposed to my last forecast looking at in the 2% range. So.
Switching gears a little bit to the labor force, you did your Fed looked at a lot of numbers with labor force participation among working age men going forward. Where do you see that as a long-term problem or an indicator for the economy long-term?
So a lot of people have studied this, and my staff have too, to understand at a time when the unemployment rate is falling, when businesses express concerns about a tight labor market, is where is the workforce going to come from? And it's unusual to look at prime age men, so those that are in a category you would think would be running back into the workforce right now, to understand why is that not happening. In some cases, and you've heard this from other sources, is it opioid usage? Is it coming from education? They don't have the skills to step into the jobs. Any number of factors come to bear there, but it's important in understanding where we will find the labor to fill the jobs that are open today.
Was there a conclusion? Is it multiple factors?
It is multiple factors.
Unemployment is 3.9%
right.
from July. 6.3 million people are unemployed. The number of people entering the workforce who were not in it was down 287,000 people to 1.8 million. But yet the number of job vacancies are increasing. Why do you think there's that disconnect?
Well, the economy's growing, and as the economy expands, that demand for labor is there. And remember, the demographics in our country mean that workforce has been shrinking, and we've seen that trend for some time. So figuring out where labor will be able to meet the demand for those jobs is going to be important. And we have seen, for example, in my region, there have been some businesses that have cut back because they haven't been able to find the labor. Other businesses are motivated to make investments in technology to try to substitute for that labor. So it's an important issue as we go forward.
Do you see that there needs to be more money put towards labor in terms of skills, changing skills, teaching folks how to do different things?
Well, I think that could be among it. Obviously, other policymakers, other economic levers, I think are what important. This is beyond the prospects of low interest rates to address fully.
This week President Trump told Reuters that he was unhappy with Fed Chairman Jerome Powell because of the rate hikes. The President's Office of Management and Budget Director in June said that the Federal Reserve puts the brakes on the economy just as it's getting good. What do you think about these comments? Does it concern you when you hear these things? Does it affect you in terms of your decision going forward?
So here's how I think about that issue. Expressions of angst at a time when there are higher interest rates is not unique to this administration. So we've seen this before, and we know that higher rates do cause adjustments in the economy. I think what's important for the public to remember is Congress understood this tension might exist between a central bank that was responsible for the money supply and those that have other angles in the economy. And so they put important firewalls in place that would allow an institution like the Fed to keep its focus on the public interest and the long-run nature of the economy. And that's what we're doing, and that's what I continue to do.
And so you think that firewall is effective then?
I think it is effective.
And necessary.
And I think over time it's proved effective. It is absolutely necessary. We know from experiences in other countries where that independence is compromised, it has bad outcomes for the economy.
The president also, at least the Federal Reserve raised rates, 3 times before Chairman Powell came in under President Trump, and 2 more times under Chairman Powell when he's in. Do you see that? And now we're starting to hear this angst, as you mentioned. Do you welcome the input, though? As long as there's that firewall in place, do you welcome the input from legislative branch, from the executive branch, or do you think the Fed needs to act on its own?
Well, the Fed's responsibility from Congress is to act according to the mandate they've given us. Do we take in broad input? Absolutely. If you look at how the FOMC operates, each of the 12 Fed presidents are talking to people in their regions. We are talking to lots of people, businesses, we are talking to community leaders, we are talking to low and moderate income communities to bring a fuller picture to this economy. So the very nature of our policy making brings in very broad perspectives to that decision making.
Switching gears a little to the capital buffers, this has been a big issue for you. You recently said that you're concerned that regulators are not doing enough to build a capital buffer for the banking system. Can you talk a little bit about that concern?
So the important thing I think we learned from the most recent financial crisis is that when you have firms that are so large that their stumble or shocks to the economy can affect the economy broadly, you want to make sure that you have appropriate levels of capital. And obviously a lot of progress has been made in building capital. One of the things you also want to make sure is that you are not being pro-cyclical at the time there's a downturn. So in other words, at the time banks are trying to conserve capital, you're asking them to raise it. And so the concept of having a counter-cyclical buffer or making sure that those capital levels are high in good times helps you smooth through the down times. I think that is very important as our economy finds itself in the good shape it's in, and these banks are profitable, that we should entertain that.
And as a Fed president, you can't really affect the policies, the requirements that are necessary here, but you can talk about it. You have a standpoint or a vocal point to talk about it. Do you think people are listening? I mean, some of the policies and the changes and the effects are having the effect of removing some of that capital buffer. The regulations are rolling back. Are you losing that battle? Are people listening?
I hope they're listening. I think we all share an interest in making sure that our banking system can weather whatever the next storm is, and it will be a different one for sure. I think we want our largest banks to be able to perform and to serve the economy in a way that is sustaining, and that's why I talk about capital. You're right, I won't make the decision on that, but I think it's important, and I think it is broadly shared, that we want a well-capitalized, a well-supervised, and a well-managed banking system in this country. And so we should continue our efforts to try to assure the public that that's the end to which we will work.
Last topic. The chairman has said that he would like to have more openness. You talk about talking with many folks in the community, talking with you getting input from everywhere. He says that he wants to have open lines of communication about monetary policy, and he's holding public news conferences after every FOMC meeting next year. How do you feel about that?
I think that was a great idea, and I think as the chairman engages in having these regular conversations after each of our meetings, it's an opportunity for the public to better understand what the central bank is doing. It should not be a mystery. We are trying to be open with what we know as well as what we don't know. So I applaud his initiative to do that.
And then also talks about forward guidance. Does that offer forward guidance? It was removed from the statement, the FOMC statements. But do the news conferences then, do you believe that they would offer some forward guidance as you go through the meetings?
Yeah, I don't think of them as offering forward guidance as much as I see them as elaborating on the decisions the committee makes, explaining the statement that comes out. And so I think the committee takes a great deal of care in how that statement comes out, in the minutes of explaining what was behind that. And I think the chairman holding the press conference will be another opportunity to do that.
So we started with the symposium. I'm going to end with the
Okay.
symposium. The shifts in market firms like e-commerce. Amazon, for instance, has 37% of the gross merchandise volume in 2017. In 2018, it's going to be 41%. It's going to be 50% in 2019. Do you see those? It's similar too with Apple and Google, with the dominance there. Should central bankers be concerned about the size of these firms and the amount of power that they wield?
Yeah. So I should be clear that our motivation for this topic was not firm specific.
Right.
It was to really understand in the aggregate that as we see concentration across multiple industries, as we see the size of firms, is to try to understand what should central bankers take away from that? How does that affect what we do? So we're not going to call out any firm by name, but we are going to ask those that are going to present papers and those that will discuss them to help illuminate for central bankers. Does this matter for us? Is it a purview of other policymakers? And what do we make of what we see today in the economy?
Well, could mega firms then wield more market power, therefore control prices, control salaries, the amount of money that's being...
It's certainly possible. If you look at the roots of the existing antitrust laws in this country, they came out of a concern for monopolistic tendencies and what harm could come to the public. I don't know that that is the issue that will come out here. It's certainly not my issue per se when I think about it. What I'm really trying to understand is how will future interest rate decisions transmit to the economy if we have a different structure than we did, say, 20 or 30 years ago. And that, I hope, is what we get insight on.
Kansas City Fed President Esther George, thank you very much for your time. I really appreciate you sitting with us.
Thank you, Edward.
Yeah, thank you.